There we go. Hey everyone, welcome to our sixth Scientific Governance and Risk meeting with our President and CEO, congratulations, Stephen Becker. He will be walking us through his enormously complex and in-depth series of articles on scientific governance. The habit or the pattern leading up to this meeting is that we never have enough time to get to all the interesting questions, so I'm going to keep my preamble to an absolute minimum, I think. And Stephen, I'm going to hand this over to you, and maybe you can give us a recap of what happened last week.
Sure, not a problem. So last week we first had a look at what the inherent risks are of supply and die using CDPs. We outlined the several risks of volatility, qualitative, liquidity, exposure, correlation, and price feed risk. I know that's a lot to take in. I don't expect you to absorb it quickly, so that's why we're going to go through it one at a time. The one thing we did try and touch on last week was the sort of qualitative risk assessment. It's a subtle but a very important point, because it is the sort of defining characteristic of how you understand the collateral that you're going to include in your portfolio. So to start off this week, I thought we'd just cover that aspect again very quickly, the qualitative risk aspect, and then maybe jump on to looking at a debt ceiling. What is the purpose of a debt ceiling and how do we go about calculating that? And if we've got time, we can obviously do the same thing for the liquidation ratio. The reason that we're going to go through these aspects is because it pretty much defines the risk profile of each collateral type that we wish to include into our collateral portfolio. And then once we understand these risk profiles, we then can have a look at how we build this portfolio and how we manage it appropriately, keeping in mind that the objective of it is not to optimize some sort of risk-adjusted return on capital, but to optimize the integrity and stability of the system. So that needs to be kept in mind. So to kick it off, I'm going to just go over the sort of qualitative risk assessments again. If one looks at an investment management perspective, you generally do two things. You do a fundamental analysis, sort of a due diligence in terms of where an organization is and how it fits into the industry, the sub-industry, and what factors of the economy actually keep it working and keep it going. And then on top of that, you do a financial analysis so that you can get a sense of the pricing, the valuation that you would attach to said organization. Now, the reason those two go hand in hand is once you've got a valuation on a particular organization, you want to have a look at the qualitative or fundamental risks inherent to that organization that will, pretty much steer you away from that fundamental value that you've calculated. Now, from our point of view, we don't need to do that financial assessment. We don't need to come up with a valuation on the organization, even though it'd be pretty cool. We don't need to do it. What we do need to do is understand the fundamental part. Insofar as it has inherent risks to pivot away from what it is actually doing. That being said, we can only do it to a certain extent. We can't deep dive all the way down into the private information of a company like you would do from an investment management perspective. So it's going to go down to a little bit deeper than a superficial level, but effectively what is available in terms of public information. We'll do an assessment on it, and we'll come out with a particular number that represents our assessment. And hopefully risk teams that join the MakerDAO organization will do their own assessments as well. Now, how do we go about doing that? Well, there's three aspects to it. The first is the initial collateral onboarding process, which really says, well, who are you as an organization? And considering that our liquidation process is all about price discovery in the secondary market, what does your trading profile look like in the secondary market? Now, I put a caveat there because not all tokens have a price discovery mechanism in the secondary market, but we can come back to that. The underlying feature of that is recourse, and that is fundamentally important. The second part is the operational assessment of the organization. This is important. You want to know what the organization is trying to do, what are the underlying governance of the organization, and if owning these risk tokens, what rights do you have as the owner to either certain obligations or certain streams of revenue that you might see in the organization, or just simply to the underlying asset if that organization has a token that is asset-backed. Now, the third one, which is really important, is the technological assessment of the token and of the organization. We found that representing yourself as a token that follows a certain protocol is really important, but to be able to integrate those tokens appropriately into our system is paramount. We can talk business until the cows come home. We can assess each other until we're very happy, but ultimately, if we cannot find a good plug point for the token and ourselves, the thing doesn't work. So it's imperative that we understand that the technology that surrounds that token fits nicely with us. Okay, so given that process, the initial collateral onboarding process, the operational assessment process, and the technological assessment process, we look at this information and say, well, what do we get out of it? And what we get out of it is an assessment. And that assessment can be broken down into 5 parts. You look at the team, we look at the core team and its advisors. Not so much as a case, as I said previously, of trying to go in depth and sort of analyze every aspect about it, but to get a sense of, do they have enough experience to warrant having faith and confidence in that particular organization, and by extension, that token. The second abstraction or grouping is the community. What is the sentiment in the community? How does the community wish to derive value from this token? And what can we get from their assessment of this organization? The third is obviously technology. This is paramount. Again, this is a part of the assessment, but there's actually a rating that we need to apply to the technology in terms of saying, well, how complete is it? How well reviewed is it? And what's the level of security? And the way we go about that is by looking for external audits that are being done, internal audits that are being done, and obviously looking at the audit that we would impose ourselves. Then the last two, which is a little bit more obvious, you've got your market and competitiveness. You need to understand where this organization is in the industry, just generally, once again, from a public point of view, and also have a look at the business models. Now, the business model is something that is very subjective, but the most important thing to take out of this is, where do you categorize the token? That is really important. Is it a utility token? Is it just a native token on a blockchain? Does it represent a security? Does it represent a process? What does it actually represent? Because that in itself will give you a sense of its longevity, its purpose, and obviously underlying value. So that was a sort of a quick rundown, well, I suppose relatively speaking, quick rundown of the qualitative risk and the assessment required in order to understand the organization behind the token. That all-in assessment will come out with an ultimate number. The number will be ranked out of 10. And by default, if, as an example, a token is ranked 6.1 or 6.3, what does that really mean? Well, what that means is that value that we ascribe to that organization will ultimately affect the quantitative values that we calculate. Because the quantitative values that we calculate does not take into consideration any qualitative aspects, because by default, the data doesn't tell us about the organization. We have to do that separately. Once those quantitative aspects have been calculated, then you can do the adjustment using the qualitative component. So that being said, let me stop there for a second and see if there's any questions and or comments.
I'm going to jump in and ask a couple. So the crypto space is enormously volatile, and we've seen situations in the past where a poorly worded tweet or a rumor proving false can have an enormous impact on the value of an asset type. So how does the risk team account for these sort of missteps in organizations that cause a value to dip?
Well, as I said, you can only have a certain amount of insight into the actual workings of the organization. So, you know, very much like your general investment in the traditional space, you are exposed to public information, and that is, you know, as far as you can interpret. You are going to be exposed naturally to these corporate events that will disturb or distress the price. The point being is that you hope that it is captured somehow in its risk profile over its history. Maybe it did have a few glitches in the past, and that had a negative effect on their price. That should be incorporated. But in terms of predicting that sort of thing, that sort of goes into the black swan situation, because you really don't know the impact. And what you do from and I'll touch on this with respect to liquidation ratio, is that when you do your value at risk assessment, that is your general assessment that you do, but you do a further one called expected shortfall, or otherwise known as stress testing. And that environment, you basically are just either looking at the worst case thing that ever happened, or you thumb sucking new worst case things that you can imagine could happen. It really is a point of imagination to sit back and say, well, stress testing means what? There's a very well derived and very well researched risk management process that allows you to consider stress testing appropriately, but ultimately it is subjective. So in terms of capturing those black swans, you effectively try your best with your stress test basket.
Richard, you're muted.
Sorry, thanks for that. David raised an interesting point in the chat that we've touched on, I think, in these meetings before, and some people have come to the same conclusion in Reddit, I believe, that in some ways, MakerDAO can be perceived as a ratings agency at this point, or even a TCR of some sort, I suppose. Is that a role that Maker wants to embrace, or is that going to be sort of just a knock-on effect that people can take as they will?
This is kind of an interesting question because it speaks to something a lot broader. MakerDAO is facilitating growth of a new economy. The transactional basis that we provide to this new economy will allow goods and services to effectively grow and develop. Now, why am I talking about this? Because effectively MakerDAO is a very good diversified play right now. It's probably, in my opinion, and obviously it's biased because I'm here, but I think it's the best diversified play in the industry, because we will be transacting on behalf of all goods and services that wish to come into this economy if our stablecoin has the traction we think it has. Now, the extension of that is that every single token that can come onto the blockchain as a good or service can also be used as a potential collateral. So that goes hand in hand. So by default, not only are you growing in an economy, but you could basically use that economy as well, and the asset value that's been created on it as collateral. So there is that effect where you seem to be taking on quite a few functions, one of which is this kind of ratings agency. Do we want to specifically be a ratings agency? Well, it's kind of like saying, do you want to be a service provider for the economy in all aspects? It's impossible to do, but it'll be a case of what will organically be required as we grow naturally on the blockchain.
All right, that's interesting. How often will we be iterating? So I want to come back to this idea that the space is volatile, and I know that you have your team has an enormously complex job, but things can change fairly quickly, and I'm wondering what the cadence is of reevaluations or reapproving through proposals different collateral types, or whether the adoption of a collateral type is sort of a commitment to constantly evaluate the health of a certain collateral type.
Well, there's many levels to this, and the level that is most important is from the risk team's point of view. Now, from an investment banking point of view, or from a general investment management point of view, risk management is not only a day-to-day thing, but is generally an intraday thing. You will constantly have a portfolio that represents something, and that portfolio will be updated on a constant basis from a price feed, and the risk will be, in effect, real time for those risk teams. Now, how you react to it has many levels, and that also depends on the mandate that you are given from the folks that represent the organization. But generally speaking, those mandates follow in terms of the severity of the issues. If it is not severe, then you can go on a well-defined periodic basis. Like for our intents and purposes, quarterly basis should be sufficient, because your 3 months will be enough time for you to have out of sample testing for your particular risk function to see if you're working as you hope to work. And if during that process you find that something changes importantly, or something changes materially, then you would need to actually create a messaging device that says something needs to change now. And you might have to interject with like kind of an emergency proposal, or you might have to, as part of the risk structure, have the ability to go in and change something immediately if there's enough consensus on it.
Which is what you referred to these mechanisms in the past as policy tools. So we need a policy tool to sort of react. Sorry, does that make sense?
Yes, it does. That's exactly it.
Okay, Jesse, do you have access to a cam? You want to? Oh, he's gone. All right, Jesse asked a question. As Maker diversifies its collateral base, does it become harder to create CDPs given the need for multiple asset types as input and variable demand for long leverage on those assets?
Let me think about this.
No, actually,
as Maker diversifies its collateral base, does it become harder to create CDPs given the need for multiple asset types as input and variable demand? No, in fact, it becomes a little bit easier. The one constraint that you have is when you have a look at the collateral portfolio as a whole. That becomes interesting because you need to understand the levers that are involved to ensure that the portfolio as a whole, ensures the integrity and stability of the system. But the fact that you have multiple collateral types will allow you to broaden the potential of creating CDPs and the generation of DAI. So in effect, I do not think it will hinder the process. I think that it will. In fact, my concern is that the debt ceilings that I would basically want to see applied to certain collateral types will probably get used up too quickly. That is essentially my fear. So we might have an initial, let's say 5 or 6 collateral types with debt ceilings, and folks are so happy about this that they immediately use it up very quickly. So you get to a point where you find your collateral level and your collateral portfolio very well balanced, but effectively replete. And then you need to adjust that again, but you need to adjust it lockstep. So it really is more the inverse problem, where I think too much CDP use might be induced.
Interesting.
Because effectively the collateral, if you think about it from a supply and demand point of view, your diversification of your collateral base and the ease of use of which you can liquidate that collateral will define how readily supply will be made available. So if you have that and it becomes fluid, then you probably expect folks to have an increased rate of use of the CDPs, given the fact that they see that continuity and fluidity. And in that case, you need to make sure that your demand can match that rate of supply as well. Otherwise, you get a dislocation. And then that dislocation will then manifest itself in the peg, or the soft peg to the dollar.
Did that answer your question, Justin?
Yeah. And I think the key, like high level point is that the diversification is at like the global level. It's not at the individual CDP level. So it's not the case that each CDP that's created has to match the sort of diversification that's set at the global level. Is that right?
No, yeah, it's basically the global level is important because what's required is to fix debt ceilings such that when they are all met, your collateral portfolio is in an ideal position. And that process of transitioning from the beginning to that particular extent is always going to be a bugbear in the system. So every time you move your debt ceiling, you're going to make sure that it's done defensively so that your collateral portfolio as a whole actually has that embedded security and safety that you require. Otherwise, what will happen is that you will have a collateral type being preferred over the rest, and as a consequence, you get not over concentration, but a concentration in one, which goes against the whole point of the collateral portfolio anyway.
Right. Okay, that makes sense. Yeah.
We could actually. Yep.
Sorry, do you have time for another question, or do you want to move on?
Yeah, no, by all means. I have questions and dialogues. I'm open for.
All right, great. Jordan has a question that sort of touches on this topic. He says, what do you think about Basecoin's suggestion that safe collateral types be incentivized or paid to open CDPs to stabilize the system? I think this is something that Arun alluded to in the chat before, that precious metals or tokenized precious metals we might look at some way to incentivize people to lock those up.
The interesting aspect about all these levers that you have available to yourself to safeguard your system, they're not black and white, they're not binary, they're very gray, and they're limited in their use. As an example, the diversification benefit that you get inherent in using multiple assets in the collateral portfolio, when you see that diversification benefit in the traditional space, you want to use it because you optimize for a specific risk return metric. But here in this particular space, we actually want to use that diversification benefit to add an extra capital buffer. Now, why do I bring this up? Because this is pretty much the same way as we look at, incentivizing certain collateral types. To a certain extent, we will be able to incentivize them using only part of a stability fee, which is aimed at policy tools. And within that policy tool, there's two aspects to it. There's a broad policy tool that will influence the supply of, generating DAI, but that is in very specific events, because generally speaking, the governing dynamics of the system takes care of the process. But there's going to be a part of that part where you might want to tweak it, maybe a couple of basis points up or down, to try and incentivize certain CDP types to be used over and above the others. But it's very limited. It's not all encompassing. I'm not going to be able to all of a sudden say, well, I want gold on board, so therefore I'm going to make it negative, because it goes away from the entire system, goes away from the integrity of the actual collateral portfolio. There is a certain amount of leverage that you have in that, but it's not all encompassing and certainly not black and white. I mean, very much like many of the main aspect that you've got to think about in terms of the provision of supply of DAI is that the governing dynamics that run the whole thing work most of the time, but there are going to be points where it does not work, and there you will need certain policy tools, and those policy tools have to be defined, not in terms of just the supply of DAI, but all the way down to the actual collateral itself. Again, these are restrictive, not all encompassing. You can't make great big decisions about it, and that's good, because being able to make great big decisions about certain collateral types will affect the collateral portfolio as a whole, and we don't want that. We want to make sure the portfolio serves its underlying purpose of maintaining the integrity of the system and creating stability for our stable coin.
David asks a question: how are trading profiles of various assets proved to be legitimate? Isn't there a lot of manipulation possible on this level? How do we know whether we can trust the exchanges?
Well, that's actually a very interesting question, because this comes down to, I mean, it's called the spade of spade, wash trading. And, you know, wash trading generates a lot of fake volume. And, you know, unless you are immediately involved in the underlying trading of that particular token pair, it's kind of difficult to figure out what it is. But you can use a general proxy, and this is the proxy. You have a look at the daily volume in comparison to the market cap. And why do I say that? Because if you find a token, given its functionality and given its utility, is above a certain percentage, you've got to question why that is the case. For instance, if you have a look at, let's call it, I'm not going to use any names. Let's say token ABC is a utility token. So you expect that on its network or on the Ethereum network, it should basically have a lot of turnover. You expect it to be around about 10, 15% of market cap per day. And it starts buzzing around 50%. Now, if there isn't something very important going on, and this seems to be a consistent measure, it is a red flag for me. It tells me that in comparison to its market cap, someone is trying to generate volume. And if you have a look at the percentage of daily volume to market cap, and you translate it into impact on actual price, that will give you further evidence that volume is being manipulated, because you should have a clear, possibly non-linear relationship between volume and price. And if you find that all of this volume produces no real price movement consistently, that's an indication of possible wash trading. So to a certain extent, we have to actually try and keep an eye on where certain tokens are actually traded as well, and capture the possibility of wash trading on those particular exchanges.
So would the risk team do things like lowering the weighting assigned to feeless trading platforms, and maybe raise the weight on distributed exchanges that are more difficult to?
Yes, pretty much. The other thing is to, if you think about it, choose a token, find out where they're traded on all the exchanges, and then have a look at those exchanges and see in general what kind of percentage trading they do as compared to the overall market cap. It either weights in their favor or goes against them. Now, this is a proxy. That means that there are going to be good players that will accidentally be weighted against, but we're hoping that it's not going to be so material that it hurts. But that should then be aggregated into the evaluation of the collateral type as well. It is a difficult thing. I'm not going to sit here and propose to you that this is a clean-cut mechanism. There's going to be pros and cons to this, but ultimately something has to be done to recognize the fact that until a fragmented market like ours gets an information processor that is regulated, we have to start looking at sort of self-regulating this process ourselves, and being cognizant of the fact where something is representative and obviously where it isn't.
Okay, great. We're coming up on the half-hour mark, so maybe we should probably dig into some new content and save some questions for later.
No problem. I mean, the other thing that we can start talking about is the debt ceiling. What's the purpose of the debt ceiling, and how does it work? And I think that the most interesting way of going about this is just asking a simple question. Why do we want a debt ceiling to begin with? Most people will start saying, well, it's got something to do with diversification. In part, yes, it does, but it actually has to do with liquidity risk. That is the be-all and end-all of why the debt ceiling is so important. The way to think about this is pretty simple. Imagine one giant CDP, and that CDP basically encompasses all the collateral that we require. If you want to, if the CDP gets liquidated and you need to, you need to liquidate all that collateral, given a certain amount of time, how much could you do without affecting the price too much? Now, there's a lot of subjectivity there. I mean, the first one is how long is the time frame that you want to give yourself, and what is the percentage level that you are willing to lose in liquidating this amount of collateral. There's an important trade-off. Most of your liquidity risk, something called liquidity adjusted value at risk, liquidity discounting, and liquidation value literature will tell you that there is a trade-off between the cost of trading and the risk of trading. If you think for a moment that you have all this collateral and you need to get rid of it, and you need to get rid of it right now, obviously the things that are going to hit you is the impact on the price, which is going to be a very, very specific, and it's called endogenous cost. And the second thing is that you basically are going to get a large transaction cost, generally speaking. If you decide to go over a longer period to try and liquidate your asset, you will have less endogenous impact price cost, but you'll be exposed to market risk. So there's the balance. So in order to try and figure out how to compensate the balance, you need to have a look at your, unfortunately, this is the basis of all finance, you need to have a look at your utility curve. That means your risk aversion. If you are risk loving and you want to basically get rid of the stuff now, that means you're happy maybe with a 9–10% drop in price by getting rid of everything. If you're more conservative, you probably take a longer period of time and say, well, I'd rather trade off that 10% impact cost with possibly 2 or 3% market risk cost. So that balance you got to take into consideration. And I've started at a certain point. I've started saying, well, let's say you want to try and get rid of all of this collateral in 7 days. And you do not want to participate too much in the market so that you impact the price. And that basically is the fundamental question of, why do we need a debt ceiling? Because we need to figure out how much we could get rid of over a certain amount of time that does not go against us. Now, I'm going to pause there for a moment, because go against us is also a very important concept, because go against us is inherent in the liquidation ratio. But are there any questions before I go into that little portion? Nothing? Cool. So I may have scared a few people off. This is getting a bit intense. In the liquidation ratio, there's obviously a percentage over and above your 100%. So for instance, right now with ETH, we have 50% being that sort of margin above 100% that we apply. That 50% above 100% is implicit of two things. One, the volatility of the collateral, and two, the ability to liquidate it. That is, fundamentally important. So if you find yourself in a position where you've got a lot of collateral and you wish to get rid of it quickly, you have to consider that if you do it immediately, you might actually suck up that 50%, relatively speaking, and actually go underwater, which means that you end up owing money on your CDP. So it's vitally important to understand liquidity impact on being able to get rid of a certain amount of assets. This feeds into the debt ceiling, and this feeds into the liquidation ratio. It actually is the fundamental basis for both. And in fact, in this market, being fragmented and not particularly liquid, it is pretty much the most fundamental aspect of risk management. And the debt ceiling answers the question from a theoretical point of view, from a practical point of view, and a defensive point of view. So theoretically, what we do is we just have a look at the general price and the risk profile of the time series underlying each of these tokens. And we just simply ask the question, if we have all the breadth and depth in the world of liquidity for this particular asset, given its risk profile, how much would we care to take on as a debt ceiling? And that's a really large number. So for instance, if we have a look at Ether, a good example would be, it'd probably be in the range of about $1 billion. That would be the fundamental theoretical value. But if you boil it down to how much you can trade on a daily basis and how much you wish to get out of over a certain period of time, then you come down to a practical level, and it'll be more or less, let's say, $550 million. Now, I'm being very super conservative. Those numbers are actually a lot higher. I'm just being super conservative. But in order to actually implement your debt ceiling, if you started from zero, would you be comfortable going from zero to, let's say, $300 million in one day? The answer to that question is no, you wouldn't, because you also need to be able to grow your debt ceiling in a manageable way, in a way that is consistent with your collateral, the integrity and stability of the system. In fact, there might be certain cases where hitting the debt ceiling hard with a massive amount of pledged collateral could in fact be construed as a certain attack. You could have an attack vector there which is intentionally trying to disturb the system for whatever sort of bad actor incentive. But ultimately, those three elements look after the ultimate liquidity risk underlying that collateral type. So again, I'm going to pause there to see if there are any questions or comments.
I'm just sort of trying to wrap my head around the various risk parameters and what they're meant to incentivize or how they're meant to limit risk, and how those relate to the debt ceiling itself. So the debt ceiling is a buffer that exists in order to cover off the worst case scenario of a range of certain volume of defaulted CDPs occurring in a certain period of time then. So
yeah, we basically assume that there's just one giant CDP representing all that collateral type, and the whole thing gets liquidated. What happens next? I mean, that is the worst case scenario, and obviously that is not, it doesn't really optimize in anything, but it's a good starting point.
And things like the stability fee would be it's a policy tool designed to disincentivize people from acquiring positions that are too risky for them to maintain, which in turn would create this risk to our debt ceiling.
Yeah, the confusion here is that the stability tool has a component which is a policy tool. The first thing that it does is the stability fee is compensation for the inherent risk to the system, and that will depend, specifically on the risk profile of each collateral type. So if collateral type ABC has got this horrible tail risk, really, really bad tail risk, which means that the likelihood of something terrible happening is actually generally a lot higher than accepted, then you need to be compensated with a higher stability fee, because that's the major component of that is looking after the compensation for that risk. But that's a separate thing. That's related to economic capital, which we'll come to in a next community call. But for now, the debt ceiling basically answers the question: how much exposure should we take? If you go back to the sort of initial risks that we spoke about, then let me just find where they are. Then exposure risk is combined with liquidity risk to give us a sense of what level of debt ceiling we could tolerate. Because there's two ways that you can also cause a heightened liquidity risk on your books. The first one is obviously by trying to get rid of too much collateral quickly. But the second one, which is also important, is if you end up with an amount of pledged collateral that is actually material in relation to the amount of tokens issued and or the market cap. So as a good example, if there's a market cap on token ABC of 100 million, and there's about 50 million pledged in collateral in our system, we've effectively got a 50% exposure to this entire organization. And if you try to, even under some very decent liquidity, if you try and get rid of 50% of a certain asset, you are going to create your own liquidity problems, even if the market itself is considered liquid, relatively speaking. So
it presents a tremendous risk.
Yeah, that is tremendous risk
for the actual organization whose token we're holding as well, because their fate is kind of in our hands at that point.
Correct. So that's why we will have the practical and the theoretical, practical, and the defensive ceilings. These are calculated from the basis of what sort of liquidity risk we're exposed to. And if by some chance the liquidity is so amazing and absolutely wonderful, it tells us that the exposure we should take is roughly 35% of the market cap, then we know that there might be something underlying the calculation that is incorrect, and we do not want to be exposed to that. So you'll have a cap on this whole thing of 20% or 15% of the exposure to that organization. So there is a very logical way of constraining this calculation from the bottom up and from the top down, so that you're never going to be fundamentally exposed to the dynamics of the actual asset in the market, and at the same time the proportional representation to the organization and its issued token. It sounds like a lot of wordiness, but effectively it's just saying don't take too much of one person. And when you have a look at how it's trading in the market, make sure that you don't go and have so much that trying to get rid of it kills you or goes against your other risk parameters. So there's that balance.
Okay, I think in the chat there's sort of a side conversation going on about CDPs. Did you want to move on to the next topic, or do you want to?
I think maybe if you just sort of dwell on this and start taking any questions and maybe just general comments.
Sure, but I have some saved up questions that we should probably get to. Let's see, what's something topical? Well, this is an interesting one. So with risk teams, can they be voted in and voted out of the organization? Can the maker voters decide that a risk team isn't working out well and get rid of it?
Yeah.
Okay.
I mean, this is a decentralized entity. MKR token holders are effectively the governors of this. If they don't like something, cheers.
So the idea is that a risk team would be a new risk team would be onboarded through a proposal and then we'd evaluate and then vote them in.
Yes. I mean, if the one aspect is that you've got to keep in mind is what is the purpose of a risk team and who is incentivized to implement that purpose. Now, there's two aspects here that you need to consider that are clear. First, if you are a significant owner of MKR tokens, you should be incentivized to have some sort of risk team in place because you're looking after your risk return evaluation of your investment. The reason is that if you are a specific collateral type and you wish to get yourself involved in a system, it might behoove you to get a risk team involved to start looking at why your token is wonderful. So there's a bit of bias on both sides. To a certain extent, that's fine. I don't mind if token ABC gets a risk team that starts looking at the in-depth assessment of their token and says, no, we think this is great, you should include it in your system. Awesome. But only so far as they can show rigorously that that is the case. Only so far as they can show rigorously with data that comes from an external third party that is reliable that this is the case. Otherwise, they're going to be seen as bad actors. They're going to basically be seen as influencing an intentional outcome. And if that is the case, then MKR token holders should be able to firstly detect the fact that there is an outlier and either ask them to correct their point of view and or their function, or vote them out.
What are the criteria to become a risk team? Is there a set checklist that a risk team would have to meet, or is it just a product of their work? It's good enough.
I think that when we first get our internal risk team voted in with our risk construct, you'll see that the minimum requirement is to actually contribute to either a part of the risk construct in terms of what MakerDAO needs and or the entire process. And it's not so much the case of do you need a team? I mean, if you have a team, if you're incorporated, it just lends more weighting to the fact that you're taking this seriously, you're going to be around for a long time. So you could have Joe Schmo deciding that he wants to be a risk team and he starts, inputting his 2 cents. It just so happens that this guy has, 6 PhDs and he knows what he's talking about, and he's very good at, conceptualizing the whole system with respect to risk. That's fine. as long as he is around for long enough to establish the fact that he is a consistent good actor. So it doesn't matter who contributes, as long as their contribution is done appropriately and it actually addresses the risk parameters in the system.
All right, the third and last part of the question, I think we might have touched on this before, but it's worth repeating. What are the benefits of being a risk team? What are their motivations for being involved?
Well, there's two ways to think about it. Number one is to incentivize yourself as an investor. You want to have a look at the risk return profile. That's an easy one, and especially if you're a whale type investor, in fact, I would probably recommend that you do it. The other one is also in terms of being a collateral provider. As I said, those are the two biases that you naturally have. But cast your mind forward, 5, 10 years from now, where MakerDAO is a fully decentralized system. It needs to obviously have service providers. And those service providers will provide a service that will be paid for. And it'll be up to the MKR token holders to figure out who these service providers are and how much they're worth. Because ultimately, everyone thinks this is a wonderful idea, getting this decentralized entity up and going with its own momentum, off it goes. But ultimately, if it's going to be this newfound legal organization, I kind of think about, when the joint stock company was first, devised hundreds of years ago, the revelation it created, what sort of ideas it incited. I think we're at the same point now with a decentralized autonomous organization. It might have that same feeling of a new legal persona. And if that's the case, well, this legal persona is an entity that requires service providers, and those service providers will need to be paid. And if you can create a decentralized version of all these service providers, you will not only have competition and collaboration, which means that you will have more effective service, but you'll have efficient service, because you should, by default, if you believe in the economics of it, you should have competition driving down the price to the most efficient level. So ultimately, this thing should work in both extents.
Yeah, it'll be enormously interesting to see how it shakes out. I have a question in my backlog here from Jordan, actually, who's in the call. He asked, will the risk team be involved in more existential governance decisions, such as how to pay foundation workers or things like that? Which I think is interesting, because this is a team of people that are analysts and risk managers and financial experts. So would they be tapped to do other tasks outside of just collateral evaluation?
If you think about it from a decentralized point of view, you've got many functions that are required for the organization. So as of now, I would probably say not particularly, but as you go forward, you could create a risk team service, and you could do a triple accounting service, and you could do a financial service, and you could do a regulatory service. There's just so much you can do that you don't necessarily have to think about it all as, okay, there's a company and a risk team. You could have a company that has a risk team and a compliance team and an accounting team and a. So it really is as far as your imagination can stretch. This is the exciting part about having such a potential organization being deployed, is that you can have any kind of construct that you wish as a service provider to this organization. And when other organizations see the merit in this, and they're going to do it as well, you might be servicing different organizations on the blockchain. So it's not just where you sit in view of and in terms of just MakerDAO. You could find that so many other DAOs out there that start up and get going are going to require services. This is a full-on economy. This is a brand new aspect.
Yeah, that's fascinating. So that the DAO model allows for sort of different departments of an organization sort of incorporating themselves and serving different organizations. So you can have an accounting group that serves 3 or 4 different DAOs, or yeah, it's fascinating. Soren, I know that we might have put you to sleep by now.
Oh, there's Jordan basically just wants to follow up. He said,
okay.
I think I meant, will the risk team look at more existential types of risk, like risks of how a DAO is run and how that could harm the system? Well, actually, Jordan, that's kind of like a cross between the underlying economic and crypto economic systems. And so it won't be per se for the risk team, but it will probably in part be something that the risk team would have to consider. Deriving the necessary governing dynamics to make a decentralized autonomous organization work is really something that many participants have to consider, not just the risk team. There are many elements to it where the risk team would obviously just be a part. I hope that works. I hope that helps you. Okay, super.
Soren, if you're still available, there's a question here that might be more applicable to you. And this is a question that's come up a couple times. It's a question about how the community will be alerted to upcoming votes, and I think this kind of is a larger question about what kind of communication channels do we have, or are we planning to put in place to keep people up to date?
Yeah, and that obviously has to evolve as we also evolve, our support for decentralized voting. It will initially start out with where the community is now. So, that will be Reddit, our Rocket chat, and, your other community driving activities where we'll add it. And as we get, better application support, we may have, different kind of things that you can subscribe to. Basic stuff like RSS feeds may also be relevant, but something where you both have a combination and of push and pull things, and just like we also are, creating an ecosystem where people can build on top of the CDP functionality. We also want to kind of create APIs so that can be open for others to also create their kind of monitoring, alerting services, and other ways to kind of give more insight and transparency to what's happening on the voting system.
Yeah, that's a good point. It's something I've been trying to incentivize in the community, is that there's this opportunity for third-party developers to step up and help us out with monitoring and specifically alerting mechanisms and notifications. So that's something that's on the roadmap. We spoke at the top of the meeting about when the first governance vote will take place, and I know that there was a change in schedule recently. Can you talk a bit about that?
Well, actually, the first vote that will happen will now be the August 26th vote, which will be to change the stability fee, and that vote will happen using the same mechanisms that the vote so far has happened, and that means really using CLI tools, and the reason for that is really that we don't want to push out a voting user interface until we are ready to let people vote safely. And what we've been working on there was the user interface for the foundational vote, which with the post that was published yesterday will be pushed a little bit out into the beginning of September, so that all people have time to acquaint with themselves with the new formulation of the foundational principles once they are posted. I believe it's probably better than I, Rich, when that is scheduled to be posted.
Yeah, I was hoping to put you on the spot there, but you turned it right back on me. I'll have to dig up that doc. I'm not entirely sure off the top of my head.
I can tell you what we're aiming for is to be able to have the vote on September 12th. And obviously people should have at least a couple of weeks to get themselves acquainted with this proposal.
All right, thanks for that. Stephen, we're at 1 minute past the hour. Was there anything else or any comments you wanted to leave us with, or last questions you wanted to address before we wrapped it up?
You're muted, Stephen.
My apologies. David was just talking up on the side about something very interesting. I mean, especially when it comes to asset-backed tokens. He asked a question about, with respect to, for instance, DIGIX, would we take an exposure, debt ceiling exposure to gold in terms of DIGIX, or in terms DIGIX's market cap, or in terms of gold overall? And the answer to that quickly is we would take exposure to DIGIX's market cap, because fundamentally it is the operation of DIGIX that we're exposed to. Because ultimately, if we had to own the whole of DIGIX not own it, but basically be exposed to all of it in our collateral portfolio, and we had to liquidate it, you probably find you won't be able to liquidate it in the secondary market. You have to have recourse all the way down to gold. And if that happens, it's probably because DIGIX failed. So in essence, thinking that you can have exposure greater than that of DIGIX is an anomaly, because you won't be able to have any satisfaction to recourse in that event. So I think Jordan asked, will the voting interface be released with multi-collateral DAI? I think that's for Søren.
So let me see. The voting interface you will get the first version of it for the foundational principles vote, which happens in September, and there will be governance votes happening before we're ready to launch multi-collateral DAI, and there will also be a user interface for that. And as we prepare to launch the first version of the user interface, we will also post blog updates about where we are with the user interface, and what the motivations are for how it is and how we see it evolving.
And I just confirmed the date. So the first vote is scheduled for September 12th. All right, okay. I think that this is probably a great point to wrap it up. Thanks. Did we just get an uncomfortable question? There's going to be announcements. We're going to have an update, David, soon about the roadmaps for a bunch of launches for multi-collateral, for the new CDP portal, for the governance interface. We're, I believe, figuring that out tomorrow, and there's going to be some communication around what those actual dates are. So we don't have anything to give anybody right now.
Yeah.
I think that's it for us. Thanks, Stephen. That was another great meeting. Thanks,
Thank you, everybody,
for waiting an hour to give us the answer to a few questions. Maybe next time we'll get to you sooner. Thanks, everyone. This will be on YouTube soon. Bye.